Welcome to the Scottish Property Podcast. This is a show where we aim to educate, inspire and entertain through real life stories and interviews from people in the Scottish property community.
As always, thanks for listening and give us a follow on social media and subscribe to our YouTube channel. Remember to join us at our monthly networking events on the first Wednesday of every month. Tickets are available on our website. So without further ado, we'll just cut straight into this week's podcast. Okay, welcome Adam Lawrence back to the Scottish Property Podcast for a second time. How are you today?
I'm all right, thanks guys. I'm shell-shocked, I suppose, a little bit, but surviving.
It's been a while since you've had you on, hasn't it? It was COVID times we last spoke.
Yeah. I tell you what, 3 years, isn't it? Yeah.
You're not going to be stuck for words for your Sunday supplement this week, I can tell you that. And we've got a bit of a budget hangover episode here. So for all the listeners listening, this is Thursday, 31st of October. Budget was yesterday. We've not had a lot of time to digest, but we've got Adam Lawrence on the show today to try and get through some of that detail and give us a wee update of what's happened, Adam. So I think just kicking off with the big one, obviously it's been a £40 billion tax raid. The big headline, employer national insurance increased 13.8% to 15%. Now, I know this really is not going to directly affect our audience, which is core property investors and landlords, right? But really, we got you on today to talk about the macro economy as well, and actually how that filters through into ultimately, inflation, interest rates, all the rest of it. So, yeah, what is that going to mean to the economy, and how does that pan out then?
Well, it's a big one, isn't it? Because of the people who work in the private sector, about 90% of them work in small and medium-sized enterprises with fewer than 20 staff. So that's a big, big deal. That's a big part of the workforce, of course. And their employers have been hit yesterday. Anyone who's got effectively 4 full-time equivalents at the minimum wage or fewer is going to be a couple of quid better off. Anyone who's got more than that in terms of their staffing or in terms of how much they pay is going to be worse off. That's basically how it shakes down without boring everyone with the details. It's worth about 20 billion quid to the exchequer, and that's the pockets it's come out of. Whether they really be the business owners or the staff, you've got less money to pay your staff. So the idea that tax hasn't gone up on working people is a bit of a joke.
This might affect most of the property industry related businesses, because most property related businesses, estate agency, letting agencies are all small to medium term businesses that fit right in that category that you mentioned.
They really do, Stu. You're absolutely right. And, between say 4 and 10 staff, which would be a lot of them, will be worse off. Their margins are worse. It means they're going to have to put prices up. So that's just covering the national insurance raid, which was not just the 13.8 to the 15, but also the fact that employers will now have to pay national insurance contributions on everything over £5,000,
yeah, threshold
gets paid, rather than 9,100 quid. So my figures were just about the change in the allowance, not about the increase, as you've correctly said, which they say is 1.2%, but really is 1.2% on top of 13.8. So it's more like 8%, 9%,
So we've managed to fill the big black hole that they're talking about, the £20 billion black hole. But really, what impact does that have, on, like you say, small businesses, employers? What impact will that have? Because some people, commentators this morning, I'm hearing, but, that is ultimately it's going to fall back on the actual employees and the working people, who they're all for the working people. By the way, are you a working person? We'll not go down that rabbit hole.
That'll be the rest of the podcast otherwise. Do you know what I mean? We don't want to go on the soapbox. But look, the thing is, national insurance for the employees was 12% at the basic level, which is the people that every government says that they want to look after. It then went down to 10 and it went down to 8 as a last-ditch attempt to try and buy some votes for the Conservatives. It didn't work and they got voted out. What the honest thing that Rachel Reeves really should have done is said before the election, we can't afford to do that. We know we can't afford to do that. We're going to have to put it back to somewhere near where it was, but probably the 10%, not the 12%, right? Instead, she thinks it's sort of clever to do that to the employers rather than the employees. But anybody who runs a business will obviously tell you have to look at the total cost of the staff. Of course, you care about what goes into their pocket and you want as much to go into their pockets as possible. But ultimately, it comes out the same pot wherever the cost comes. So if you look at businesses that are going to employ lots of bodies that that are all going to be impacted by this who are on lower wages. So if you looked at, and from a property perspective, anything that has hospitality involved, any commercial property with leisure tenants, things like that. Care homes would be another one because they're very people intensive. They're not really places where you can create lots of efficiencies and use lots of AI and all the rest of it. Realistically, you just have to have fewer bodies doing more work, which every employer would love to have at the end of the day, but it's easy to say and difficult to do, right? The cost of that is looking at going up around about, very roughly, about 10% next year with all the things that have been considered. If they're pegged to minimum wage, with those rises in employers' national insurance contributions, you're talking a 10% increase. And where does that have to filter through to? As you know, to the bottom line, it has to filter through to the prices that everybody pays. Well, so even if the employees have got a bit more in their pocket, they're still going to get...
I was thinking of the knock-on effect on it. As a small business owner, if you're looking at the overall cost of an employee, when it comes to wage rise time, you're not going to be able to afford to give them the wage rise to keep up anyway. So effectively, it'll be less money in their pocket anyway.
That's exactly right. Because that money is going to have gone without the employee ever seeing it. And they're of course, they don't understand employers' national insurance because it's not their problem. It's not for them to worry about. They're probably going to, some will think you're lying to them or whatever, but it's a horrible situation to be in because that's happening before you've given them, the wage rise. I mean, at national minimum, you've got no choice. So all of those businesses, Stephen, are just going to get pushed into a corner and you're going to see more empty buildings that were retail, hospitality and leisure. There's just no doubt about it in my mind. Not everyone is going to be able to swallow another 10% increase on prices.
I mean, we know you like a bit of a prediction, and a forecast, right? So how does this affect, ultimately inflation, CPI rate and interest rates? So at the moment, bring us up to date. What we are inflation and what's the bank rate? Is it 1.7?
Yeah, 1.67.
So that's as far as CPI goes. Yeah, absolutely. But do bear in mind, September was a perfect storm month where you had an increase in sterling strength, a drop in the price of oil, loads of other things going on. In October, we know we've already had 10% rise in the energy price cap. So people's fuel bills have gone up. We've also seen the oil price go back up a bit and sterling's got a lot weaker against the dollar. And the gilt yields have gone the wrong way because of all this extra money that's being spent. Although at a macro level, I'm largely supportive of investing in the economy. We've got to do it. Not doing it leads to what we've been dealing with after the last 14 years of the way that the Tories have run the investment side of things or not. And also the pandemic, to be fair to everybody. You still got that money has to come from somewhere ultimately. So yeah, it's not I'm glad to see we're investing, but yeah, inflation at 1.7 is not going to be 1.7. And if you take if 50% of your cost is staff and that cost is going up 10% next year for some of these businesses, that's 5% you've got to find from somewhere. Even if you can swallow 2% on your margin, 3% still got to go on the price, hasn't it? And that's the absolute base minimum. And then everybody who supplies you has got all those cost pressures. So your costs end up going up 10% across the board and your prices have got to go up 6 or 8%, or you're going to go broke. You're going to go broke.
So how long do you think this will filter through into the inflation figures?
I think it'll keep inflation pretty buoyant over the next few years, to be honest, because it will have to. And you're talking inflation at closer to high 2s, maybe low 3s. We haven't really, apart from CPI, got low inflation at all at the minute anyway. It's just CPI. If you look at core inflation, if you look at all these other measures that there are, they're still coming in around the 3% mark. So we're probably in the real world these days that we live in. Honestly, everybody's pretty comfortable with 3% inflation, but no government wants to come out and say we're doing a 3% inflation target. So actually, if they were going to do that, they'd have to coordinate it with the European Central Bank and probably the Federal Reserve so that there wasn't a problem across the board. They'd all have to agree to do it on one day.
So if we stay around the 3%, even, that'll be higher than the government's target of 2%, but you think that won't really have a big impact on, Bank of England are not going to have to step in there, even if it's 3% and start hiking the rates again? Because at the moment we're on a downward and everyone was feeling a bit positive, and there was talk of rates coming down to, bank rate coming down to maybe 4% and stuff like that. The next, we've got an announcement in November, haven't we, coming up? So what are they going to do? What are they going to do in November?
Well, I still think they're going to cut rates. next week, right? I still think they'll cut rates by 0.25%. I don't think yesterday has changed that particularly, because where we are at the minute, 5% is too high. It stifles the economy, and now we've got difficulty in job creation. It's more difficult today than it was yesterday morning, right, to create new jobs. There's no two ways about that. So if they want to make sure the economy's still moving along properly, they're going to need to cut the rates. So the rates really should probably be down at about 4% at the moment, and it wouldn't make a big difference to anything. It's getting below that 4% barrier that's going to be a problem in general, maybe even 4.25%. So I don't see us going back up unless something changes dramatically. I think the Federal Reserve set a target between 1% and 3%. Everybody says 2%, but really they've got a range. The Bank of England, it works slightly differently. So in 3 years' time, the forecast has got to say inflation is between 1.5% and 2.5%. That's the rule, although everybody talks about 2% being the target. That's the actual metric upon which they're judged. So really, it's what their forecast says. And yesterday, the OBR updated all their forecasts for inflation. And I think they said 2.6 for next year, 2.8 for the year after. And then they were back into the low 2s, which keeps us pretty happy. But they forecast above 2%. And I think they're right in what they've done yesterday.
I mean, I think that even if we're sat at the 5% as we are now, I think, things for us up here anyway, things are still working. We can still make things work, on the interest rates as they are just now. So
yeah, but we had a huge rent increase though, which outperformed England. So it's working because of that rental inflation.
Yeah, we definitely rents.
The market and the rent caps have pushed things into that in Scotland, haven't they? And they're doing so much damage. It hurts the tenant at the end of the day, and the landlord has got to raise a higher rent because the cost of financing is more. And of course, we're now in the 5% bracket, so we nearly join you at that terrible 6% ADS.
Well, that was the biggest hit yesterday, wasn't it?
Come on to that, actually. Just hold fire on that, because we're going to talk a bit more property specific in a minute. But there was one other thing that I want to just mention as well, which is going to contribute to the kind of higher inflation, is the increase of the wages. So the minimum wage has gone up from £11.44 to £12 something, I don't know.
21, I think it is.
Yeah, so that as well, because you touched on it there about the bulk of the inflation, because our economy is built on services mainly, isn't it? So service inflation, obviously, that all ties in with wages, doesn't it? So surely that's going to have an impact as well.
It definitely is, and we haven't had services inflation below 5% for a long, long time. So it's not going to be going below 5% now on the basis of the conversation we've just had. And like you say, that's about 3/4 of our economic output at work in services rather than production or manufacturing or construction.
Let's take a quick break, guys, from today's show to talk about selling your property with Prime Property Auctions. Now, myself and Stephen have both used John and Lewis from Prime in the past, and we can personally vouch for their service. They sell vacant and tenanted property, and you get to control the minimum reserve price so that you're not selling your property for peanuts. They pay for all the stuff like photos, videos, and all the marketing stuff up front, so you're not paying anything from the start, and it's a no sale, no fee. So if you want to check out Prime Property Auctions, then get across to the link on the show notes and speak to the guys. I think somebody came out, it was like, if you look at it, it's the wage increase, somebody, when you compare it to the actual rate of inflation, was it 3 times?
That'd be about, well, if you compared it to the 1.7, it's more than 3 times, isn't it? Because that would be, it's nearly 4 times the rate of inflation, but that's a bit naughty, because September's it just so happens that September's figure is the one that's used for index-linked benefits.
Right, okay, so we can't, the 1.7, we can't really get carried away with a 1.7 figure then.
No.
Okay, cool. Yeah, I mean, I think obviously getting on to the property stuff, it was all this hype, wasn't there? So Keir Starmer was repeatedly coming out in the news. Oh, it was all doom and gloom. This is going to be, everyone was thinking it's going to be terrible. The capital gains tax, right? Get on to that. What happened to the 40% capital gains tax?
Well, you know what though? You've seen these days how it works. They were talking this morning on something I was listening to about 30 years ago, when someone leaked something from the budget and it was a sackable offence. Now they leak the whole thing, including their ideas, to try and gauge what the public really think. and then they act accordingly. But the big mistake here is calling it a month after they could have called it, because you've just spent a month in complete paralysis. Now, some of us...
Or panic mode.
Yeah, absolutely.
We had a solicitor that she owns farms, and we were buying 3 cottages from her yesterday, and she squeezed us until midday to sign the missives 2 weeks earlier, in case they changed it immediately. So we had to sign it before 12. Like, no loan offer in place. Like, just need it signed. What?
Well, I was working as a consultant on a business sale, and they had the documents. All the documents were all finally agreed 8:15 on the night of the 29th. And they went and signed them that night. They were that worried.
Wow.
So, and it's a good job they did, because if they hadn't, then it would have been a problem yesterday. Not a big problem, but still a problem. So you've seen all sorts of tweaking with business asset disposal relief and capital gains, as you say. But what I found interesting yesterday was when you look over to what's left of the Tory benches in the Houses of Parliament, which are not well populated these days, as you know, and they mentioned about the CGT, it was deathly quiet, because no one can really sit and argue that a move from 10 and 20 to 18 and 24 is unfair, problematic, really makes a difference. It really doesn't, to be honest. People will swallow tax rates up till about that sort of 24, 25, 26, 27, 28%. Then they start to really moderate their behaviour. But the thing is, will there be a lot of people out there who now don't trust Labour not to do more next year? Maybe,
just
maybe.
to summarise for the listeners as well, just because we're trying to inform them what the rates are as well. I mean, I'm sure they can see it from the BBC News website and all the rest of it. But so unchanged for residential property, 18% for the lower rate and 24% for the higher rate. Unchanged.
Correct.
Yeah. Okay. Cool. So again, a lot of speculation on that one, and it's almost like they let it run, didn't they? They let it run. They let people panic, so that now we're sitting here today going, "Phew, that wasn't so bad, was it?"
That is expectations management for you, isn't it? Absolutely. What was all the fuss about? Yeah, there was. It really didn't move the needle too much.
You want to touch on the stamp duty?
Yeah, that was the biggest hit, I think, from you guys' point of view, was the raise from the additional dwelling supplement from 3% to 5%.
Now, that was the one that wasn't leaked, was it, really? There wasn't even a whisper about that. And you can go back and look through what I've been saying on social media. I've said for weeks and weeks, look, the thing is, Labour don't so much refer to Scotland anymore since they've sort of lost their grip up there, although things are changing again and all the rest of it. But obviously they've been running Wales technically for some time now, and Wales has a 4% rate. And I was saying a few weeks ago, I'd be surprised if they didn't look at a 4% rate, because they love to refer to how well things are going in Wales, even though they aren't really economically going very well at all. But the 5% did catch me by surprise, I must say. But I'm not surprised to see it. And what happens in these situations is there's a big spreadsheet, and as long as it can be forecasted that it's going to bring more tax in, not less tax, there's all these knobs to twiddle and all these things to play with. And they reckon this will raise, 200 million extra a year within about 5 years. That's how they think. That's how they see it working.
When does that come into effect?
Well, how much would you say it's affected the PRS in Scotland? It's difficult to take out the rent cap stuff, isn't it? Really, that's the difficulty. So, when SNP brought in, they brought in immediately. It was from that announcement. But I think
it's midnight, wasn't it? From midnight.
It was midnight yesterday. Yes, it's coming today.
Or came in effect. Yeah. That's
so again, the best way to do is stamp duty change, to be honest.
Yeah. Again, just to summarise for the listeners, in case people are getting confused with this, because if you're not aware, Scotland has got its own property taxes devolved from England. So since 2022, we have had an increase from, this is called the ADS, Additional Dwelling Supplement, from 4% to 6%. So we've been running at 6% for a couple of years now. So, when we look at social media and the Instagram, Facebook comments, and we hear all you guys moaning about 5%, I was having a laugh to myself yesterday.
I think for Scottish investors, almost levels the playing field a little bit, because there's a lot of guys in our group that have been investing down in Northeast England. They're like, fuck paying the 6%. We're only going a couple hours down the road. We'll just get 3%. So the fact that it's very, very close now almost kind of levels that playing field a little bit more.
Yeah.
Agreed. We've got our own little terminology for it now that I learned yesterday. HRAD, we're calling it, which is an anagram of of hard, which makes it harder, let's face it. But there we go.
Yeah.
But do you not think the higher barriers to entry for property investors to create the businesses and pay this bigger tax kind of makes it a little bit better as well for us all long term?
Well, for people, I think if you split your business into two, like I do when I'm thinking about these sort of things, the existing stock, it starts to make a bit of a moat around it. Do you know what I mean? It puts you in a strong position. Buying stuff, either you've got to accept lower margins, you've got to pay lower prices, which means you do fewer deals. Again, that's just the basic economics of it. If you guys had 3% ADS rather than 6%, you would do more deals. That's the reality of it. And some of that would land in the vendor's pocket and some of it would land in your pocket. So there's probably, at a simple level, 1% being taken off the vendor and 1% being taken off the investor yesterday, I'd say, something like that.
I mean, I've got to say, for all, if we do have English listeners here, I know, in fact, I know we do have quite a few, for all those people that are saying, oh, buy to let's dead again, all the rest of it, the kind of doom stairs and all the rest of it, we've had this now for a couple of years, the 6%, and I have a letting agency and we have portfolio landlords. And in the last 2 weeks, some of our landlords have been buying properties. We've taken on 6 in the last 2 weeks. It certainly still works for a lot of people. So, and then I think somebody put a comment like that, on social media, and then I think it was like Danny Inman or something like that. He came back. So somebody said, we've had 6% in Scotland for ages, and he came back and said, 2 Bob properties on 2 Bob properties. So, I think obviously in the higher stuff, like London, South East and the rest of it, if you're paying 5% on a £500,000 flat in London, that's going to hurt, isn't it?
Well, and HMOs and things like that down in the southeast, absolutely. So let's look at the flip side of that. It makes it much more attractive to either A, buy portfolios, because you can still benefit from the non-residential rates, which will be lower, right? Or B, buy limited companies that have already got property assets in. And of course, there's been more and more and more of those popping up. And there'll be people after all this who go, well, it's not worth, if you run a limited company and you run one property out of it, it's not viable to do so because of the costs of running the company and everything else. So there'll be lots of people who've started companies who've got 1, 2, 3 properties in them who now just go, I don't know if I can make it work anymore. If you can buy the company, you're paying stamp duty on the shares at 0.5%. So it's not as easy as all of that. I should qualify that because it depends on the existing financing, depends on all sorts of stuff. But there's always a way. There's always a way.
Yeah, no, that's really interesting. Without going too far into the rest of the detail, but there is a couple more things that I wanted to check with you and what your thoughts were. Inheritance tax and pensions. So, in the property community, a lot of people do SAS pension because there's benefits there, and you can invest in commercial property and all the rest of it. So with your pension, let's just have a look at what the proposals are there. Can you summarise just with first of all, inheritance tax? That was quite a big one, wasn't it?
So inheritance tax, there's a few different bits that featured in yesterday. So one of them was freezing that threshold for 1 more year, which gains more money into the Treasury. So
this is the 325. Yeah,
so 325k limit. Yeah, absolutely. Now there's other tweaks around things like BPR, business property relief, agricultural relief, which affects farmers. So they will have to pay almost an effective rate of 20% IHT or a rate over and above £1 million. So they won't be able to pass these assets down through generations anymore without there being a big tax bill, which means they've either got to insure it or they've got to give it away before the inheritance tax threshold kicks in. But it's pretty difficult to predict when you're going to die. So it'll be the ones that die who haven't done their planning or die as a bit of a surprise that get whacked with all this stuff. And you'll see farm assets and things up for sale on the back of it. There's no two. The problem with things like inheritance tax is really the people who tend to pay it are the people who've got estates that are worth between about 1 million and about 10 million. Once you get past about 10 million, hardly anybody pays anything because they've paid for much more salty structuring with trusts and all the rest of it that takes the IHT out. And she's had a bit of criticism this morning for leaving the super rich alone or whatever. But the problem is you can't really touch them because they will move away. They will use all these structures. You just need them to spend money and employ people really and hope for the best and provide funds to property investors hopefully as well.
That will affect farmers quite a bit then, won't it? Because, a lot of them are are probably asset rich and cash poor. So if they, like you say, they've not been well planned or there's an unexpected death, they have to offload those assets very quickly to pay for a tax bill.
100% correct. Anybody who's watched Clarkson's Farm or anything like that will tell you that it's not atypical. The asset rich cash poor piece is spot on, Stephen. Absolutely spot on.
And on pensions, then there's quite a big announcement on pensions.
Yeah, killer really, because I think there's a few ways to look at pensions, isn't there, in property? We often talk about SASs and SIPs and stuff like that. SASs are great, but one of the great things about them is they have been a vehicle until now to get a cheap trust without a big administration cost attached to it outside of your estate. And effectively what they're saying is that's being, over time, but over the next few years, being brought back into your estate for inheritance tax purposes. So it doesn't exist as a separate entity anymore. It'll be on your assets and liabilities statement, your probate, when you die.
And is that going to be 40%? Is that a flat rate?
At the
40%.
At the 40, huge tax differential. So what really you'd expect the behaviour, I'm always keen on sort of looking at what does it mean and what are people going to do about it and how are they going to behave. So people where people who've got, they're wealthy, but again, they're in that sort of 1 to 10 million bracket. They might have left the money in the pension for future generations and survived on other assets, other income. Maybe they've got property income, stuff like that. Instead, now it'll pay much more to get the money out of the pension as quickly as possible and then distribute it one way or another. Because a lot of these loopholes are being closed. But the pension thing wasn't really a loophole. It's a bit of a betrayal of people who saved for all those years in order to get money outside of their estate. But that's where we are.
So you think that will see on that bracket, the 1 million to 10 million, it'll see an increase in people maybe setting up trust structures?
I think you will, yeah. I think you will. I think it'll become much more popular, and there'll be all sorts of RISAF planning is one that comes into view, which we won't get into in detail, but I'm sure you're going to hear that a lot more in the property community over the coming years. Yeah,
that's absolutely. The thing. In the last few years, it's been so heavily focused on guys that have been building up assets inside limited companies, and they're going, okay, the next step's the SAS pension. We can protect our estate, so that's going to affect our industry quite a lot.
Well, if you're a 40% taxpayer, let alone 45 or 46 if you're up there, then you've got to think about your corporation tax, which obviously has gone up over the last few years, and then your dividend tax if you're going to pay dividends. You're losing half the money to pull it out of the company. So the old way of looking at it, the old money way of looking at it was put it into the SAS, because instead of giving half to HMRC, you give half to the SAS and you can borrow the other half back out and use it for property transactions. It was clean as a whistle, really, and that hasn't changed per se. But what's changed is you're now not going to want too much money in the pension.
So did I read that if it's passed on to you, so if I had died and it passed on to my wife, then she wouldn't get the tax on that part of the estate. But if it's like your kids, then it would, wouldn't it? Is that right?
That's exactly how IHT works, Nick. Yeah. So your interspousal is free of inheritance tax, right? And then your wife inherits your nil rate band. So your 325 that we talked about, plus your 175 on your main residence, right? But if you're not married for a start, it's a bloody good reason to get married. Although there are plenty of reasons not to do it, but let's not dwell on that. But yeah, if it's kids, and if you die without a will, a lot of people don't realise this, but if you die what's called intestate, so you've got no will, what automatically happens is half of your estate goes to your wife. So that wouldn't attract IHT, but the other half goes to the surviving relatives. So that would immediately attract IHT, which is why it's a bloody good reason to have a will.
If any of my 3 kids are listening to this podcast after I die, sorry guys, I think I'm just going to spend a lot, to be fair, because I don't want the government getting 40%.
Don't want to.
You know what? Although they say many a true word spoken in jest, Nick. The thing is, I think there is an element of encouraging that, in that cashing in pensions and spending the money will become more of a tempting strategy for people. Yeah. Which of course helps the government because there's VAT and all the rest of it. So maybe they've been pretty clever there, which is maybe why I look so bitter about it.
Yeah. One line that I picked up on, which wasn't really talked about too much, right? But I want to get your thoughts on this as well. And again, I might be wrong here, just reading some of the news articles. So they said £3 billion military aid or something for Ukraine, right? But then they said as well for obviously Labour have got this push to build 1.5 million houses over the next 5 years, and then their figure for affordable housing is also round about the £3 billion mark as well. And I thought, well, 3 billion for Ukraine, 3 billion for affordable housing. Obviously, what's your thoughts on that? Like, is that not affordable housing and the housing crisis? Is that not a big thing that you should be putting a bit more into?
Well, that's what we've been told, isn't it? I mean, if you work on about, the average housing association gets an average of about 150 grand grant, right, to build an affordable house. That's only 20,000 homes. Right. So it doesn't move the needle, is the reality of it. And the thing is, Rachel Reeves knows that money is needed. You'll have noticed, I'm sure, over the last few weeks, she's already said social rents are going up above inflation. So without getting into a long diatribe about it, this was one of the things that George Osborne cut in 2015. And there was this long promise of CPI plus 1% was the business model. George Osborne cut that, and it was actually going up lower than inflation, or it was being frozen. And that caused a big problem because these investment funds look on 20, 25, 40, 50-year time horizons, and they go, well, if we can't trust the revenue stream, one of the things that attracts them into property is inflation-linked rises to rents, right? If you take that away, they stop investing. Rachel Reeves has guaranteed that for 10 years, although she can't really control that because someone could come in the next parliament and reverse that if Labour were to lose, for example. But that is a smart thing to do. But she knows she's got to throw money at social rent. And what's going to happen when the LHA rate goes up at the beginning of 2025? Like you guys know more than anybody, because the rents in Scotland have absolutely rocketed. They're going to go through the roof, and everyone's going to be moaning about the housing benefit bill again. And everything goes up, and everything goes up, and everything goes up, and everyone's in the same position, really.
That's interesting.
And yeah, no, absolutely. Thoughts on, I mean, this is only one budget and the first budget of the Labour administration. So, I mean, anything could happen over the next 5 years as well. Is this just the start? Like what, they're going to look at maybe, are they going to look at, I mean, what's your thoughts moving forward? They're going to keep...
Well, I think they've learned. I mentioned earlier that it was a very bad idea to have such a long gap before doing this budget. And then the way they've communicated around it, like you said, Starmer saying doom and gloom and all that, it's not funny because it's meant businesses have been paralysed for 6 or 7 weeks across the economy. And that's a terrible shame because that costs us all money and growth and jobs and all the rest of it. Right? That won't be reversed now. Now, what you've got to believe is that this is the worst one. They've come out and said this, this is the bad one. We've done this. Things are going to improve from here. But if you look at the Resolution Foundation, who, if you're not aware, are quite a left-wing think tank that come out, but they're generally focusing on low-paid working people, right? They've said that people on low pay are going to be worse off over the next couple of years, not better off. And actually, everyone's going to be worse off by a bit from the budget yesterday. So, of course, money doesn't come out of thin air, does it? It's as simple as that.
Well, one thing I wanted to touch on as well was the benefit that Scotland had. They gave, 1.5 billion immediately, and they're going to give another 3 billion next year. Is that just a political move, obviously, because our election is next year, and they're going to want to try and get the SNP?
I mean, obviously, there's been action at the SNP headquarters, it's fair to say, isn't it, over the last sort of 18 months or whatever. And politically, I'm sure they're trying to buy unionism as the way forward. I don't know how many people will have changed their minds or not. I think, in honesty, when it comes down to the inevitable another referendum whenever it happens, then ultimately what that's going to boil down to is how do people feel about what it would mean to leave the UK and join the EU, which is a really difficult problem to try and get your head around. It's not really just about nationalism, is it? It's about, are you better off here or there or all the rest of it? It turns it into, instead of it being in or out, it turns it into in UK, out of Europe, in UK, in Europe, which is not an option anymore. You got 4 quadrants, haven't you? So I think there is a bit of that. But I also think, from a leveling the playing field perspective, it is congruent with what they said they were going to do. They did a similar number, 1.7 billion for Wales, was it? Something like that. So that they are trying to do a bit of what they said they were going to do. But whether that really moves the needle up in Scotland, you guys would have to tell me,
To unite the government, effectively.
I think that's what they're trying to do.
Stephen's portfolio is in Aberdeen, and there was a levy announced on energy companies, wasn't there? An extra windfall tax.
That's right. They've extended the what they call the sunset date, haven't they? So they can keep taxing them. I think it's 38% they're paying at the moment. And in many ways, it's sort of fair because a lot of that money that they made came about because the prices went up so much. So it is a genuine windfall tax. I don't know that it needs to go on for so many years, really, but that's the thing about tax, isn't it? Once it's gone up, it's struggled to get it back down again.
Yeah, I mean, I think that just in summary of it, I think the biggest thing for me is when you look at the freeze and the threshold rates and the fiscal drag, as they call it, for the technical term, that's, in my opinion, that's the biggest tax, isn't it? You know, freezing that.
You're absolutely, and that is exactly why the Resolution Foundation have said what they said about people being worse off, because it's all very well seeing all these headline numbers and all the rest of it, but if every coffee shop, cinema, bowling alley, whatever, puts their prices up by more than you're getting paid, and if you're lucky enough to get more money over the thresholds, you're losing more of it anyway because it buys less, you're then absolutely. But of course, the government are self-interested in promoting inflation at more of a 3% level because they've got all that debt that goes down in nominal terms, just like as property investors. We benefit from the nominal debt that we have. So they're the biggest beneficiary of inflation. But if the government benefits, the people don't, whichever way you slice the lemon, Nick. Do you know what I mean?
And we've not even touched on things like bond markets. You talk a lot about bond markets and things in the supplements. So I've never really got my head around it, if I'm honest with you. Still.
Well, let me give you a sort of 1 minute that I think everybody can understand, right? Yeah. I look at the 5-year gilts in the UK. So we have to borrow money over a 5-year duration. That's the interest rate we end up paying, right? That has been between 5% in the middle of last year and about 3.25% on Christmas Day last year. It was down to about 3.5% after the Bank of England last had a meeting, and it's up to about 4.25 yesterday because Rachel Reeves is borrowing extra money to find for investment in infrastructure. So there's got to be a cost to that, right? I look at those rates and add on a rule of thumb, 2% for the rough cost of a limited company mortgage. So at the moment, I'd be expecting rates to be around the 6.25% mark. Obviously, the rates come down if you pay the arrangement fees because that's how the banks sort of make their margin. But they've got to make a margin on those loans, and that's the margin they can make. So that's why I watch them, and that's why I'm so interested in them. What happened yesterday was they dropped quite a bit because I think there'd been a lot of speculation she might come across as irresponsible, and she didn't come across as irresponsible. But then they ultimately went up again towards the end of the day because people thought, well, hold on, we still need more money as the UK now. We're still borrowing more money, not less money. So more money means more risk, means more cost to that. But again, going back to your question earlier about the Bank of England, when we get next week, then we'll find if the rates go down 0.25%, the bond yields will probably again clip back a bit again to more like the 4% mark.
Excellent. You explain things really well there, Adam. The listeners will be really appreciative of that. Just wrapping up shortly, last couple of minutes. You as Adam Lawrence in your own personal business, how does this reflect through to you? How are you feeling about it this morning after having a bit of reflection?
Less cheery than I'm looking here, I'll tell you that for free. Well, I've got a few business interests as well as my property portfolio. So those small companies will struggle. They're exactly in that bracket that we talked about earlier on, letting agencies, stuff like that. It's going to be a struggle. There's no two ways about it. Lower margins, harder, probably have to lose some heads, certainly won't be creating as many jobs as we might otherwise have done. So I don't feel great about that because I think I take seriously the responsibility of employing people and providing employment for people. In terms of, and Stephen said it earlier, there'll be less competition out there because of it. I wouldn't be surprised if we got more than our 2% extra, what you guys would call ADS discount, because I think next month or so it's going to be tumbleweed at the auctions, absolute tumbleweed. People aren't going to want to be buying because they're going to be waiting and seeing what happens. And then, of course, we've got this renters' rights bill coming in, haven't we, in probably the middle of next year.
Again, don't stress, guys. Don't stress about that. It all works out in the end. It's fine,
I often cite Scotland as an example of what happens when you get rid of Section 21. It was probably a big fuss about nothing. But also I cite Scotland because the rent cap stuff has not been a good outcome for the tenants, as you guys well know. Rents are probably up 20% in the last 2 years now.
Yeah, if anything, we benefited, which was totally against what the government were trying to achieve. Anyway, brilliant, absolutely fantastic. Where can people give yourself a plug, Adam, because you do a phenomenal job with the kind of macro, what do we call it, proponomics, isn't it?
That's right, yes. I've got a YouTube channel called Proponomics with Adam Lawrence, so it's MIX on the end. So I try to post once a week a video that I'm going through the Sunday supplement that I also write once a week. So that's quite a wordy piece, but it's all about property and economics and the macro.
How long does that take you, by the way? How long does it take you to write those articles?
AI doesn't write that, does it? That's you, Adam.
No.
That is me. It's 100% me, I'm afraid. Yeah, AI's not there yet, Steve, and I'm waiting for when it is, to be honest. If you try, it just does it wrong, so there's no point. So honestly, if it's easy, because there's a lot to talk about, 2.5 hours.
Really?
If there's a lot to do. I've spent up to 8 hours before doing it, which is a bit cracking.
Just lock yourself in a room, just like...
It keeps me on top of everything. I do pretty much do lock myself in a room.
To give you good clarity.
Get up really early in the morning to do it.
To give you good clarity writing that, because it is, when I found the time to read it, it does give
massive clarity, and that tends to be the feedback that I get from people. And if people want to connect, then absolutely look me up on LinkedIn. Partners in Property website is where I post the supplement every week as well. Just connect with me through LinkedIn and subscribe to read the supplement on there. I'd appreciate it.
Fantastic. Well, we couldn't have got a better summary. Post-budget hangover the day after. Absolutely brilliant. So we really appreciate your time, Adam, and hopefully you'll join us again soon. Thank you.
It's a pleasure, gents. Thanks for inviting me.
Thanks a lot, Adam.